Hi, I'm Ms. Bergeron, and today we're going to go through Chapter 17. So Chapter 17 is going to talk about financial statement analysis. So we've already covered all of the financial statements, the income statement, the statement of owner's equity or stockholders' equity if it's a corporation, the balance sheet, and now the statement of cash flows. So this chapter is going to teach us how to make those statements even more meaningful, and that is by performing financial statement analysis on it. All right, so first we're going to be talking about how financial statements are used to analyze a business, and then we're going to actually do a horizontal financial statement analysis and also a vertical financial statement analysis. And finally, we're going to be computing some of the more standard financial ratios. And you've probably heard about some of these in the news, especially when they're talking about the stock market. So we're going to find out how to actually compute those and how to use them to draw conclusions about a company. All right, so number one, let's talk about how financial statements can be used to analyze a business. So besides just looking at what is net income, what is the balance sheet telling me, we can actually perform some computations on these and gain even more insight into the business. And that's what we'll be doing in this chapter. All right, so to determine the financial performance of a company, we can compare its performance in several different ways. The first way is to look at from year to year. In other words, did we make more net income, for example, last year than this? That's comparing year to year. The next one is to compare it to a competing company. How did Walmart do compared to Target? And then the other way is to look at the industry as a whole. How did Walmart do compared to all of the retailers in their industry? All right, the three ways that we're going to do this, first is horizontal analysis, and that's going to be comparing year to year. Because if you think about the way we look at financial statements, and if you remember the columns that you have, a lot of times a company will put 2019's information here, and then right next to it, 2018's. So if we look across, we're actually seeing 2018 to 2019, so we're comparing year to year. That's why that's called a horizontal analysis. The vertical analysis, which means up and down, is going to be us comparing items inside of the financial statement. So for example, if we compare total revenues to utility expense, we're looking at items vertically in that financial statement, and that's going to be called a vertical analysis. And the final way is a ratio analysis, which typically is just a numerator and a denominator divided, so it's a ratio, and there's lots of different ones, and we're going to be talking about the most popular ones and the ones that are talked about most when comparing companies. That's called the ratio analysis. Okay, for all publicly traded companies, there are available to anyone that asks for them or looks for them corporate financial reports. Smaller companies or non-publicly traded companies also have these, but they may not be available to the general public. But an annual report is going to provide the information about a company's financial condition. And you could go online right now and look for any corporate reports for the publicly traded companies, such as Walmart, Target, Apple, Google, McDonald's. There are lots and lots of publicly traded companies, and you could actually look at these and perform these ratios on them. These ratios are typically also published online and available to us to look at. So if you just go out and take a look at it, you'll see a lot of information. All right, so the annual report is going to include the management's discussion and analysis of the financial conditions and results. It will have an independent opinion from an auditing company such as Pete Marwick or one of the accounting firms that's going to attest to the reliability of those financial statements. Then it'll have the actual financial statements and then notes to the financial statements. All right, so now we're going to look at how to perform a horizontal analysis of the financial statements. So this is, again, looking at from year to year. So many decisions hinge on whether the numbers are increasing or decreasing. So if you saw a company that was starting to decrease, then you would know that that could be an issue. So let's think to a company that has decreased. A good example to think about is Blockbuster. I don't know if any of you guys remember a time when we used VCR tapes rather than DVDs. And then from DVDs, we still use DVDs, but we're sort of moving on into more digital formats, right? So there was a company called Blockbuster. Some of you guys may have actually shopped at a Blockbuster, where you could go in and pick out, used to be VCRs. They did go ahead and upgrade to DVDs, but what they did not do well is figure out how to compete with things like Netflix and iTunes. So eventually, the digital formats caused a problem and they could no longer compete and they went out of business. So what you would have seen for Blockbuster for a horizontal analysis is that their sales from year to year declined. And again, that was because of the technological changes that they weren't able to keep up with. And if you would have looked at their expenses, you would have seen that they were not able to decline fast enough, and therefore they ended up with net losses. So they were still paying out salaries, they were still having stores, they still had the same expenses, but sales were declining. And so if you looked at this year over year, you would have seen this decline. So this is called a horizontal analysis. So let's look and see exactly how we calculate the numbers. We're going to use our example of Smart Touch Learning. They had net sales of $858 in 2020 and $803 in 219. So the first thing that we're going to do is we're going to get the difference. Remember, difference just means to subtract. And so we're going to say that it went from 803 up to 858. So I always look at the first year compared to the second year, and it increased. And it increased by an amount of 55,000. So that is my dollar amount of my change. That's going to be your numerator. Then you're going to divide that number by the oldest year. We call that the base year. So the oldest year was 2019, so your denominator is 803. So if you say 55,000 divided by 803, and then just times it by 100 so that it's in percent format, then you can see that it was a 6.8% increase. So what you could say then is that from 2019 to 2020, then their sales increased by 6.8%. And that's what a horizontal analysis does. All right, so if it was negative, if it had gone down, you'd call it a negative 6.8% decrease. So one thing that's important here is that let's say that from 2019 to 2020 you had a 6.8% increase, but then from 2020 to 2021 you had just a 2% increase. Although you still increased, here you can see that you did not increase at the same rate. So that could be a red flag, and that's why this is so much more helpful than just simply glancing at the numbers. We're digging deeper, finding out more information about this company. Okay, so now let's look at an income statement that has the horizontal analysis computed on it. So in this situation, we have the net sales revenue from 2019 to 2020 went up by 55,000, and when we divided it by the base year, we got 6.8%. So that's good. We increased our revenue by 6.8%. But even better than that, when I look at my cost of goods sold, it did not go up very much, 0.8%. So what this is saying is that I sold it for a higher price, but I didn't have to pay more for these items that I got. So my gross profit actually increased by 17.3% because of that. So again, I increased my sales price for what I was selling, but I did not have to increase by nearly as much what I was paying for those goods that I sold. So that gave me a 17.3 increase. Then I did have some changes down here, but none of them were as big of items. In other words, they didn't have as much impact as these sales, because note that sales revenue is 858,000. Cost of goods sold is 513,000. So these are big numbers. So when I come over here and I say my selling expense did go up by 10%, yeah, but we were only talking about from going from 114 to 126. So that didn't make that big of an impact. So when I come down here, my net income, which is a real important number, actually increased by 84.6%. Okay, so when we put everything together, we see that from 2019, 26,000 to 2020, 48,000, it had a pretty significant increase. So this is a good thing. But by doing this horizontal analysis, you can make more sense out of these numbers and sort of put together what may have happened in this company to cause these changes. All right, the balance sheet horizontal analysis looks the same, and you're going to calculate it the same. You'll take the difference divided by the base year, and these are your horizontal percentages. All right, next let's look at the trend analysis. This is the same as a horizontal analysis, but you're analyzing more than just 1 year. So the formula for this is that the trend percent is equal to any period amount divided by the base period amount times 100. So any period amount, 858, divided by the base year, oldest year, 750. That's 114.4%. 2019, 803, divided by 750, 107.1%. And so the base year will always be at 100% because it's just itself divided by itself. So this is how you would do a trend analysis to see what had happened over more than just 1 year. From 2016 all the way up to 2020, we can see what percent of our original sales we've grown. All right, let's look at the vertical analysis. Remember, that's up and down. So the way to calculate this is any specific item in your financial statement divided by the base amount times 100. Now, this base amount for the income statement is always your revenue, your net sales revenue account. They may call it something different, but it's always as a percent of your revenue. So in this case, revenue will always be 100%, and then cost of goods sold can be seen as a percent of total revenue. So if we're doing 2019, it'd be 509 divided by 803, and that is 63.4%. So in other words, our cost of goods sold cost us 63.4% of total revenue. If we wanted to do 2020, we would just use 2020s over here. So that would be 513 divided by 858, and that was 59.8. So what I can see is that in my vertical analysis that my cost of goods sold was less as a percent of sales in 2020 than it was in 2019. So that's probably a good thing. All right, we can do this for each item, and we will. Let's just do one example of an expense. Let's do administrative expenses. So again, it'll be administrative expense. That's any line item divided by net sales revenue. So 118 divided by 858 is 13.8%. So we can see that our administrative expenses are 13.8 of our sales revenue. And that is the vertical analysis because we're looking at these items up and down. We can do the exact same thing for balance sheet, but our base will always be total assets. You could also say, or total liabilities plus owner's equity, because total assets are the exact same number as total liabilities and stockholders' equity because it's a balance sheet and they have to match. So it's easiest if you just remember everything as a percent of total assets. All right, so 29,000 divided by 787 equals 3.7%. So cash is 3.7% of our total assets. So what is making up most of our total assets? Well, in this company, 64.4% of our total assets is actually property, plant, and equipment. So I would say that this is probably a heavily capital-intensive company. In other words, they need quite a bit of equipment to carry out their operations. If instead we were a service industry like H&R Block preparing tax returns, this would be a lot less because all they need is computers and a few buildings that they may even rent, and so they wouldn't have as much property, plant, and equipment. Instead, all of their items would be coming from salary, so they would actually see more expenses and they would not need as many assets to operate. Okay, so that is what we can see in a vertical analysis on a balance sheet. Now let's look at common size statements. This is going to use what we've just learned, and it's a way to compare two different companies that are completely different in size. So if we had two companies that were different in size, we could just look at their percentages rather than numbers, and it's easier to make conclusions about how their operations are going for them. So in this one, we have Smart Touch Learning and Learning School. And it doesn't matter how big or small this company is, we can see that Smart Touch Learning is spending a lot more per sales revenue on their cost of goods sold, and Learning School is getting it at a much less price or selling it at a much higher price. But at any rate, as a percent of sales, their cost of goods sold is much lower than Smart Touch Learning. And we can do the same thing as we go down. They're spending more on selling expenses, so maybe they're spending more on advertising as a percent than Smart Touch is. but they're spending less on administrative expenses, so perhaps they don't have as many administrative costs. They have a lot more interest revenue, so they must be investing some of their money and making some interest on it. But they also have they have less interest expense because this is a negative number. So you can just go down that and make your conclusions comparing these two companies. All right, benchmarking is the practice of comparing a company with other leading companies. There are two main types. You can benchmark against a key competitor, so just Walmart to Target, or you can benchmark against the entire industry average. So when we do this, we could look at Smart Touch Learning and we could compare in a graphical analysis Smart Touch Learning to Learning School, and we could make some conclusions about them. Remember how we saw that cost of goods sold was a much bigger piece of the pie for Smart Touch Learning and much smaller over here, but these Learning School had more operating expenses and less over here. So this would be benchmarking. We are comparing, in this case, competitor to competitor. All right, so next we're going to learn how to compute and evaluate the standard financial ratios, the most popular ones. So we have different ratios that are going to tell us different bits of information. Ratios are usually used for, these are some examples, to evaluate the ability to pay current liabilities and long-term debt. That's important. We need to be able to pay our vendors what we owe them, and we need to pay off any long-term debt on time. It's also going to help us to evaluate the ability to sell merchandise inventory and collect receivables. We need to make sure that our merchandise is not sitting on the floor too long and becoming obsolete. And we also need to make sure that the company is collecting their receivables timely and not getting a lot of bad debts. It's going to help us to evaluate whether or not we're profitable, and it's going to evaluate the stock as an investment. Does it have a good return for the investor? All right, so you're going to have your financial statements, and you'll need your income statement, balance sheet, and sometimes your owner's equity or stockholders' equity in order to compute these. So the rest of this is going to be mostly formulas, but I want to talk about them because sometimes it can be a little bit tricky as to how to get the numbers for those formulas. So that's what I'm going to spend my time on for the rest of this presentation. All right, so we've got our balance sheet, we've got our income statement, and then we're going to talk about, first of all, the category of what ratios will help us evaluate the ability to pay current liabilities. So the best ones for that are going to be called working capital, cash ratio, acid test, sometimes called quick ratio test, and the current ratio. Now, you don't have to memorize these for me, or if you do have to memorize any, I'll tell you up front which ones. For the most part, what somebody in Principles of Accounting 2 is expected is to know what ratios are in an overall sense of understanding, and to understand where to go to get those numbers. So we're just practicing using our financial statements, and then understand how this helps us to evaluate a company. So less memorization and more just understanding how to compute these and what they mean. Okay, so working capital, the first one, is simply current assets minus current liabilities. So what you need to know is, where do you find current assets? Well, assets are recorded or reported on the balance sheet. So you'll look to your balance sheet and you'll find all the current assets. Remember, current just means that they will be used up or turned into cash in less than 1 year or operating cycle. So cash, accounts receivable, inventory, these are current assets. So what is not a current asset? Things like property, plant, and equipment, things that will not be used up within a year. All right, and then we subtract out current liabilities. These are liabilities that we will be paying within 1 year. All right, so working capital for 2020 for this company is $120,000. For 2019, it's $110,000. All we did was we found our current assets. Let me show them to you. 262 minus 142. So we look on our balance sheet, current assets 262, current liabilities minus 142, and that is your working capital. So all your current assets minus what you have to pay soon gives you what you have to work with, your working capital. All right, let's talk about the cash ratio. So that's going to be cash plus cash equivalents divided by total current liabilities. You know what cash is. That's usually your cash that's in your bank account and any petty cash that you may have sitting around, plus cash equivalents. All right, so what are cash equivalents? These are items that are so easy to turn into cash for a company that they might as well be called cash. So let's look on our balance sheet and see if we have any cash equivalents. We do. We have cash and cash equivalents together, so we can just take that number. If it was broken down, it could say cash, and then it could say money market account. Well, a money market account is very easy to take money out of. It just pays a slightly higher interest rate, and so that could be considered a cash equivalent. Another thing that could be considered a cash equivalent is if you had easy to sell, very liquid investments that are so close to cash that we can call them cash. That would be another cash equivalent. All right, so we're going to say cash plus cash equivalents, just our one number for us, divided by total current liabilities, and you already saw that, and that's going to be your cash ratio. Now, ratios only help us if we know either last year's to compare it to, or industry standards or competitors to compare it to. So if I just tell you 0.20, that doesn't mean anything. But if I tell you ours is 0.20 and the industry's is 0.40, then you can start to make conclusions. The acid test ratio is very similar, except for it's going to include cash, short-term investments, plus current receivables as your numerator, and then total current liabilities on the bottom. So what this does is it says, you know what, I don't want to include all my current assets because I might have some inventory, and I want this to be a quick ratio to say, how am I doing if I don't sell any more inventory? So I'm not going to include inventory up here. I'm only going to include cash, short-term investments, and what my customers currently owe me that I can reasonably expect to receive, divided by current liabilities, and that gets you to your acid test ratio. There's another ratio like this called the current ratio, which includes all your current assets as the numerator, but this one just includes these, so that if you don't sell any more inventory, you've got a better idea of how you're doing, even if nobody else comes into your store and buys something from you. All right, so this is the current ratio. This one is everything on top, including your inventory. Total current assets divided by total current liabilities. And you know how to get all of those, and then we compare it to the industry average. All right, now we're going to look at those ratios that will help us determine the ability to sell our merchandise and to collect our receivables. That's important. How well can we sell our merchandise, and are we collecting the amount of money that people owe us? All right, we're going to have 5 to do that with. All right, the first one to talk about is inventory turnover. This just tells us, on average, how many times do we turn over or sell all of our inventory per year. It's just an average number. All right, the way that it works is that the numerator is cost of goods sold. You know where to get that. You get that on your income statement. So I'm going to pop up there and just let you look at it, make sure that you know where to get cost of goods sold from. So your income statement is right here. And for 2020, this is your cost of goods sold. All right. And then your denominator is your average merchandise inventory. All right, you know where to get merchandise inventory. That's a current asset, so you find it on your balance sheet. The word average in accounting just means the average of the beginning of the year plus the end of the year, which is divided by 2. Because to get an average, you have to take, let's say, your grades divided by how many you have. We're just going to be averaging 2 years worth. So it'll be the beginning of the year plus the end of the year divided by 2. So let me show that to you. I'm going to find my balance sheet because that is where merchandise inventory is. So I would say 111,000, that's the beginning of the year, plus the end of the year, 113,000. Add those together and divide by 2. That's how I calculate my average. So whenever you see average in accounting, and by the way, you only average balance sheet accounts. You never average income statement accounts. So beginning of the year plus end of the year divided by 2. Okay, so 513 divided by your average gives you 4.58. So that means I'm only selling my inventory 4.58 times during the year, but the industry average is 27.7 times. So other people are selling their inventory far more quickly than I am. So that could indicate a problem. Now we can see even more of what kind of problem this is by looking at the next one called days sales and inventory. This tells me how many days on average it's taking me to sell my inventory. And I already know it's going to be more than the industry average because of that previous ratio that I just did. All right, so this one is going to use what we've already calculated as inventory turnover. So remember, we already calculated inventory turnover. So we already know our denominator is 4.58. So all we do is put 365 days, because that's how many days are in a year, on as the numerator. And if we say 365 days divided by 4.58, we can see that on average, it is taking us 79 days to sell our inventory. Whereas the industry average, it's only taking them 13 days. So either we don't have enough customers coming in, or not enough customers are choosing our inventory, or perhaps we don't have the right sizes in our inventory, but there is some sort of an issue here that it's taking us so much longer to sell our inventory than the industry average. All right, gross profit percentage is very helpful. It's going to measure the profitability of each net sales dollar above the cost of goods sold. So you're going to put gross profit as your numerator. All right, and everybody stop and think about, where do you find gross profit? Remember, gross profit is sales minus cost of goods sold equals gross profit. So you'll find that on the income statement, and then divided by net sales revenue. So I want to pop over here and let you look at that. Okay, so you're going to say gross profit, 345, divided by net sales revenue, 858. And that's going to give you your gross profit percentage. All right, so in this case, ours is 40.2 and the industry average is 43%, so not much difference. All right, accounts receivable turnover is going to tell us about how many times the company collects the average receivables balance in 1 year. All right, so on top we put net credit sales, which you can get from your income statement. And then on the bottom, average net accounts receivable. And now you know how to get averages. We're going to look at the beginning accounts receivable plus the ending accounts receivable balance divided by 2. And we find out that it's 8.6 times. So we're collecting it much slower than the industry average. So it's taking us, we're only collecting accounts receivable 8.6 times, whereas the industry average is collecting it 29.1 times. I like to look at it more closely here in days sales and receivables. This is going to show me how many days it's going to take me to collect. Now keep in mind that typically you give your customer about 30 days to pay. So if they're going to be current, they would need to pay within 30 days. So here's what you're going to do. You're going to say 365 days divided by, and this is the number you got on the previous slide, accounts receivable turnover ratio. So 365 days divided by 8.6, it has taken me 42.4 days on average to collect. So some of my customers are late, and that could indicate that I need to change my credit policies. Perhaps I don't need to allow customers to purchase on account. I might need to tighten my credit policies and check their credit reports and say no to those that might not have such a good credit rating. Or maybe I need to hire somebody to call them and ask them to please pay on time. Or maybe I just need to bill them more soon and be more clear about when they need to pay me. So whatever it is, I may need to make changes based on this. Okay. So the next ones are going to evaluate our ability to pay long-term debt. So there are going to be 3, and the first one is the debt ratio, total liabilities to total assets. So you'll find those 2 numbers on your balance sheet, and then you'll divide them and compare to your industry average. Debt to equity ratio, you'll also find on your balance sheet. You can find total liabilities on it, plus you can find total equity. Let's go look and see where you find total equity. So total equity is right here. It's made up of your paid-in capital plus your retained earnings, and that gets you to your total stockholders' equity. So that's that number right there. And then, of course, you know where your total liabilities are right there. Okay, so that takes care of debt to equity ratio. Now let's talk about times interest earned ratio. This is going to help us see what is our ability to pay our interest expense. Now, all this does is it says, on average, how many times could we pay our interest expense? So you say net income plus income tax expense plus interest expense divided by interest expense. So you can find net income and income tax expense and interest expense all on your income statement, and then you divide it by interest expense. And so in 2020, we could pay our interest approximately 4.38 times before we ran out of money. Of course, we only need to pay it once, but the higher the number, the better we're able to pay it, so that's a good thing. And then 2019 is 4.07, so we've actually improved it a little bit, but we're still not as good as the industry average. They could actually cover their interest expense 7.80 times. All right, now let's look at profitability. We're going to have these ratios, 1, 2, 3, 4, 5, to help us to evaluate our company's profitability. So the first one is called profit margin ratio, and this is going to be net income divided by net sales revenue. So both of these items are on your income statement, and you divide and then compare to your industry average. Your rate of return on total assets, this one you're going to need both your income statement and your balance sheet. The numerator comes from your income statement and your denominator from your balance sheet. And this is going to tell you, it's going to measure the company's success in using assets to earn a profit. So if it takes a lot of assets to earn a little profit, then it may not be a good number. But the companies that don't need as much assets to earn profit are going to be less. That's why it's so important to compare it to an industry average to see how you're doing, because certain companies need lots of assets and others don't need lots of assets depending on what their line of business is. All right, the asset turnover ratio measures the amount of net sales generated for each average dollar of total assets invested. So you will say net sales revenue divided by average total assets. You know how to get the average, so you just take total assets beginning and ending divided by 2. So on average, our asset turnover ratio is 1.20 times. Rate of return on common stockholders' equity. So now we're getting into those that an investor, somebody that bought company stock, would be very interested in. So this is going to show how much income is earned for each dollar invested by the common shareholders. So if you put net income as your numerator, but you subtract out preferred dividends. The reason we subtract out preferred dividends is that those are promised to preferred stockholders, and this ratio is to compute the rate of return just for the common stockholders. So we're going to say net income minus preferred dividends, if you have any, not every company does, divided by the average common stockholders' equity. So in this case, we only had common stockholders, so it's just the beginning of the year plus the end of the year of stockholders' equity divided by 2. All right, and so it is 14.2%, which is actually higher than the industry average. All right, when a company has a higher rate of return on stockholders' equity than its rate of return on total assets, this is called trading on the equity. Trading on the equity is earning more income on borrowed money than the related interest expense, thereby increasing the earnings for the owners of the business. All right, let's talk about earnings per share. This is something that you'll see in the news a lot. It's a big deal. As soon as earnings are released, the investors are going to be looking at the earnings per share. So the numerator, again, is your net income minus preferred dividends, because that's the income that's available to common stockholders. And then you divide that by the weighted average number of common shares outstanding. So in other words, if you have, well, let's just go and look and see this has 10,000 shares outstanding, but let's go look and see where we can get this from. It's not always easy to see. Okay, so we have to be given it because you're not given this information on this slide. Sorry about that. So a lot of times it would actually say common stock, no par, and then it would say 10,000, well, it might say 50,000 shares authorized, 10,000 shares issued and outstanding. So it did not tell you that here, so it has to tell you that someplace else. It needs to tell you how many shares are outstanding, or at least give you something that you can compute it by. So in this case, we'll just give it to you so that you just know what it is. And we'll just tell you that on average they have 10,000 shares. Here. So in 2020, we had $4.80 per share. That means that the company earned $4.80 per each share of stock. Doesn't mean that the shareholder is going to get that, because they're only going to get what dividends are declared and paid to them. But the higher this is, the better, because it means that the company is earning that much per share of stock that it has issued and outstanding. Okay, so besides dividends, there are other ways that we can determine if an investment is good or not. So Shopify, I actually bought some of this stock, just a few shares, several months ago, and I just want to show you that if you sell it at a profit, or if it goes down to loss, that also affects whether or not it was a good investment for you. So for example, if I look at Shopify right now on Friday it closed at $332. Okay, I'm just rounding. So $332. But if I bought it back in 2018 at the beginning of the year, I can see that it was $110. So if I want to see how much I would profit by selling this right now, this is the calculation I would do. Okay, and by the way, Shopify doesn't pay a dividend, but other companies such as Apple and Walmart and plenty of others do. So you have to look at each company. So when we were evaluating Shopify, we would say, well, they don't pay a dividend, but let's look and see what their stock price has done. So when we want to see if we'd have a gain or loss, this is what we've done. Let's say that I had bought 50 shares back in January of 2018 for $150 each. So I invested about, this is an example and a what if, this is not any numbers that were actual, $7,500 into this company. Well, if I were to sell it on Friday at the current price of $332, then that would be 50 shares now priced at $332. So I would actually have a gain of $7,500, that's my original price that I put in, minus the proceeds that I would get now of $16,600. So I would actually have a gain of $91,000. I'll make that look positive so it's more clear. I mean, $9,100, sorry. $9,100. So from January 2018 to current, if I had invested 50 shares in Shopify, I would have a $9,100 gain. So when we evaluate stock as an investment, we could look to see, first of all, whether or not we would have a gain or loss when we sell it. Right now in Shopify, I'd have a gain. So that's a good thing. And whether or not they pay any dividends. Right now, Shopify does not. So these are the two ways that we can evaluate stock as an investment. All right, a price earnings ratio is going to be the ratio of the market price of a share compared to the company's earnings. Now, the market price of Shopify right now is $330 or so, right? And so that's called the market price. And then their earnings per share is just based on their net income per share. So this talks about the market price per earnings per share. There are plenty of times in the stock market where something goes up very, very fast, but they don't actually have real earnings to support that market price. That's because a lot of investors are flocking to it. Likewise, there are other times when something drops very fast. By the way, Netflix is something that's dropped very fast lately. They had an earnings that came out that was below the expected, and so therefore their stock price dropped pretty significantly for about 4 days in a row. And it probably dropped as a higher percentage than what their net income did. So looking at the price earnings ratio can let you see some of that pretty clearly. So you say market price per share of common stock divided by earnings per share. All right, dividend yield is going to tell you the stock market's value that is returned annually as dividends to shareholders. So not every company issues dividends, but if they do, you can calculate the dividend yield. So it's the annual dividend per share of stock divided by the market price per share, and that is the dividend yield. So you can compare companies. Let's say you're thinking about Walmart or Target, and you could compare their dividend yield to see which one is higher. The dividend payout is just going to measure the percentage of earnings paid annually to common shareholders as cash dividends. So it's just your annual dividend per share divided by your earnings per share, which we calculated earnings per share in a previous slide. All right, so there are some red flags to look out for in financial statement analysis. Analysts typically look for these signs to show that there may be financial trouble. Movement of sales, merchandise inventory, and receivables, earnings problems, decreased cash flow, too much debt, inability to collect receivables, and buildup of merchandise inventory indicating that people are not buying it, and that would indicate a problem. This is a table to look at how we analyze a business, and it is just going to give you a summary of everything that we've done. So it's a good thing to look at. You could print it out of the actual PowerPoint and use it to refer to anytime you want. I'm just going to scroll through it so that you can see all of it. And that completes our slideshow, so let me know if you have any questions. Thanks.